This is Eric Mwathe, the educational trader. I do thank you guys for attending the first part of the live webinar because the examples are too many to put in a short session. Of course, I've already talked to you guys and you guys are aware this is part 2 of the live webinar, and I'm going to be going into details. Some of the things that I left out in the webinar are going to be discussed here so that you can consider them whenever you're trying to find stocks to go short, especially stocks in markets that have been going higher or just individual names that have been going to the upside. So there's lots of things to cover. Now I'm hoping to be able to cover a lot of ground here. Now, if you want to go straight to the picks, the best picks I have for you to the short side right now, go to part 3. Go to part 3 if you want to go to the best short pick ideas I have for you guys. You can go to part 3, but for now I would encourage you to stay here and go through this seemingly long educational part, which is a continuation of the initial live webinar which we just had. So I'm going to begin the video here by going into and looking at some of the main things that I did not cover. Now, of course, I talked about, that's a closing high. Stock comes, tries to break out, fails. So that's your first inclination that the stock could move lower. And then we have stock moving lower, settles down, tries to move higher. Now by this time, let me try and see whether I can add some color here. By this time, the moving averages are showing something like this, crossover. So what you want to do is this lowest close is going to be your area to go short or to sell an instrument, any stock, any market. So at some point, whenever the market comes down and breaks this level here, that's your second indication to go short. Of course, your third indication that momentum is to the downside is this crossover between the 10-week moving average, and sometimes I use the 13. Either one of them works, and the crossover between the 10-week moving average and the 34-week moving average, and sometimes I use the 33-week moving average. You can use either of these, either the 10-week and the 34, or the 33-week moving average, which these ones are too close, so it doesn't matter. These ones, just pick whatever you want. I honestly think that 13 and 34 are the actual numbers. Most investors use the 10-week moving average. In fact, Investors Business Daily, or IBD, is notorious for using the 10-week moving average. I suspect that the actual mathematical number is 13 and 34. Why? Because this is a Fibonacci number, and so is this one. Like Fibonacci number, we start with 0, 1, 1, 2, 3, 5, 8, and then you got 13, and then 21, and then you got 34, then you got 55, and then you got 89, and then you got 144. Yeah, I do know these things off head. Anyway, so you see the 13 there and the 34. I believe those are the natural numbers. So if you really want to do it the right way, I would be using 13-week and 34-week moving averages. For the purpose of this video, I'm going to stick to either of the two, either the 10-week or the 13-week moving average. But to me, this is where the numbers come from. All right, now let me erase all that. Okay, we're already 4 minutes deep. I want to talk about something here. There's something I didn't talk in the live webinar, and it is this point, very important. Stocks have a tendency, and you just need to train your eyes. There are billions and billions of data points at any one given time in a market, and it's very hard to find some of these ideas, but you will find them just by looking. Whenever you're going through your charts, you'll just observe these things. So don't stress yourself. You're not going to just find them just by waking up and you'll find 10 of them. But as you go through your daily looking at charts and whatever you do, these things will become more familiar. But the thing I want to talk about is this. You'll find a stock moving out of a range. So let's call it a channel. Stock moving out in a channel, and at some point it breaks. All right, so I want to draw a line here. It's important to understand. So this break point here, that point of break, for some reason stocks will always come back and test the break point and fail. Now when they fail, guess what you're supposed to do? When they fail, you are supposed to go short there. Remember, this video is about going short. It's not about going long. So we're going to stick to short ideas and things to look for. And you'll find that the stock would, again, sometimes even do it more than once. Come here to this previous break point, move above it even momentarily, and break. And I also have to caution you that you can use this on any time frame, weeklies, dailies, hourlies, whatever. I'm going to stick to the weekly charts, and I'm also going to stick to the monthly charts, mainly because I'm looking to own an idea to the short side for a couple of weeks and a couple of months. Okay, so I'm going to stick to these two time frames. So what will happen again is the stock will come and form another base down the road. This is important. Break again, and now this becomes your new break point. Draw another line here, and the stock is going to come in the future, test this point and fail. Guess what you're supposed to do? You're supposed to short here, just like you shorted here and here. And what you're doing is you're shorting the back test, the failure to hold above that previous break point, and also the failure to hold above that previous break point. Don't be surprised that they also, down the road, the stock will come and break again. Break there, becomes a new sell point. Draw a line. In the future, down the road, the stock is going to come, test that level, and if it fails, guess what you're supposed to do? You're supposed to short there. Now, remember, if you find that the stock is not failing to hold support, for example, if the stock breaks out of that range, that's a buy point. So you really have to be cautious here. If it breaks out of that range down the a former break point, if it breaks out down the road in the future, that becomes a short-term buy point, but not the most serious buy point. But I'm just telling you that form a break point. So you have a break. So the stock was going up, it broke down. This line becomes an area to watch. If it fails here, short the stock. If it recaptures this level, you want to be cautious and understand that it could be beginning a move to the upside. All right, so we've talked about that. I want to talk about another aspect here of the crossover between 13-week moving average and 34-week moving average. Remember, I've said you can use the 10 or the 33. They're pretty close. All right. You can use either or. I mean, you can use, I don't want to confuse you, 13 times 33 or 10 times 34. Doesn't really matter. Pretty much around the same thing. All right. What I want to talk about is this crossover. So you have 34-week moving average, and then you have the 10-week moving average. They cross over there. So they begin bearish crossover. So now this crossover here is important to understand what's going on. Let me do that another way. What you're looking for, a stock has been moving. Remember, we are trying to short winning stocks. Stock has been moving higher. That's the 10-week moving average. Okay. And so now what you're watching for here is this bend. This bending, it was moving higher. All right. And a good stock is going to be bouncing off the 10-week moving average or the 13-week moving average. They do that. They bounce off this 10-week moving average. Now, what you're watching for is this bend, because this bend gives you an idea of what's going to happen down the road. And what's going to happen down the road, if the stock is going to go lower, is we're going to have something to the effect of, this is now the 33-week moving average. So let's draw it like that. So this point here, once you start seeing this bend, understand something here. understand the mathematics of it. The only way these two things, these two lines, the black line, 10-week moving average, can cross underneath the 13-week or the 33-week moving average, the only way they can cross in a bearish crossover is if, and only if, there's one way, if prices decline. That's the only way, okay? That's the only way you can influence the 10-week moving average. So it's important to understand that once you start seeing this bend, you start looking for areas to go short, because as this thing starts bending, the only way it's going to cross over here is with continued price action to the downside. Okay, so we really do need to understand that this bend is the big deal here, because once it starts bending, you start anticipating the crossover. And the crossover is because we're using weeklies and monthlies, it's going to be crossover, it's going to be good for the next couple of months, couple of years, couple of weeks. So, okay, so I'm going to take that off. What I want to talk about is, so now you have that. Let me draw the colors back here. Remember, the video is going to be long. Got lots of things to talk to you guys about. So you have that forming there. And then you got this crossover here. What I wanted to talk about is, because you already see the bend, let me see that in a different color. You're seeing this thing bending. You start anticipating. So the price is going to come. Let me use a different color here. Price is going to, oh, yellow is not a very good color for purpose of what we're trying to do here. I'm going to use, anyway, so prices starts coming down. And at some point here, it's going to stop. And then it's going to attempt to move higher. Now, this closing price here, remember, you are anticipating the crossover, right? So this lowest close, the lowest close here on a weekly basis, becomes your next short point. Important. If you want to understand the rest of this video, you have to understand that. So prices come down, down, down. They stop for, they make a low here, and then the next couple of weeks, at least 1 week high, they have a one positive week or more, okay? And the next time this thing comes and cracks that level here, you want to go short, because now you already know that this is going to move lower. The 10-week moving average is going to bend and cross underneath the 33-week moving average. And so you want to take advantage of this mathematical fact that for this to cross over, they have to see a price moving lower. So your entry point is here at the break point. And why? The break point should be just around or in the area close to this crossover, because the only way the crossover continues is with continued price action. Now, I'm going to show you lots of examples, so that's going to become clear. But understand that you want to wait for that. So the prices are, that's your 10-week moving average. That's your, let me get that off. I didn't do that well. So you're going to get a crossover at some point between those two lines. This lowest close here, prices go up for a week, at least 1 week or more, 1 week or more. And the next time this low is broken, right there, you want to go short. All right. And let's say it settles down here again, goes up for a few days, a few weeks, at least 1 week or more. And the next time it breaks below that, that's another area to go short. Because remember, you know that this can only continue crossing over and continuing with the separation here is with prices going lower. By separation, I mean the prices here, the 10-week moving average is getting very close to the 34-week moving average. They cross over, and then now they start separating, because as this one comes lower and this one comes lower, you get this separation here. So crossover and a separation. All right. All right. So that was the first thing I want to talk about. Now, it's probably the most important thing I'm going to talk about now. Why is it that everybody always tells you this is now the most important thing? Oh boy. Anyway, all right. So this is very important. So pay attention. Note this down. Monthly. And I did not talk about this in the video. It is perhaps the most important factor in going short. The most important factor in going short. And what is that? It is 3-year low. On what? On the RSI and the MACDs. 3-year low. There is nothing more important in my book when you're trying to go short than this factor here. You want a fresh 3-year low in the RSI and in the MACDs. Now I'm going to show you lots of examples, so relax. But that is more important than anything you've had in this video before now. This is what makes stocks move to the downside. There is nothing more important than this. 3-year low. I cannot emphasize this enough. This is the most important thing. If you want to make money going short the stock market, this has to be a requirement. Absolute has to be a requirement. Okay? So now that we've covered that, I want to take a look at some examples. So just give me a second here. Right now, everybody knows that JCPenney is struggling. While I was just about to make this video, I came across this JCPenney weekly chart, and I want to share with you some of the main points here. Of course, the stock had tried to break out here and failed. All right, so that's your first mistake, red flag. You might not go short there, but if you really, like I said, there are billions of data points. So by the time it's breaking down, maybe you're watching other factors. But understand, you might come into play down the road. But notice one mistake. Try to break out here, would come back and fail. All right. Let me clear that chart so we can have a clear. So it fails here. And for the purpose of education, that break there was our error number one, red flag. Okay, so it comes down, settles down. Remember now, this is nice because it has a weekly closing low right there. Maybe you can see it, maybe not. But so you draw a line there, and then notice one thing that happens. It's very important to note that we have the 10-week moving average crossing underneath the 33-week moving average. So your entry point to short JCPenney was here at about $34 here at the break. All right, is that confusing enough? I hope not. I hope it makes sense. So you came here after you failed this breakout. You came down here below the 10-week moving average, below the 33-week moving average. You try to rally, and so this weekly closing low there becomes your line. So you want to short it there. Also, you could have gone short when it failed to hold above the 10-week moving average, and also failed to hold above this crossover. And once you see the crossover, that there's a possibility of lower prices. All right, you just know that from the mathematics of how things work. I also want to point out something very interesting is if you draw a trend line here, remember we say that this here, it moved above that level there, so that was a short-term buy. It would come back and fail there, and it also failed to capture above that line there. So what I'm saying is these charts have a lot of data points. Let me start that all over again because I want to show this clearly. You can watch this video in pieces. You don't have to watch all of it in one day. So there's that line there, and this line comes from this break here. Break. All right, so it stalled here. That's just an additional information. Look at another trend line here. Right there's another trend line here. And by the way, some of you might not know this, but whenever you're drawing a trend line, you want to get the closing prices. Closing prices are best where possible. Closing prices, 3 points or more is ideal. You want the closing prices. Sometimes I see people drawing them at the lows, and because they'll be low at the lows. You can do that, but if you really want to do it right, you want to get the closing prices. So when I'm drawing my trend line in this particular example, I'm looking for the closing prices, so I can draw a nice trend line. All right, a straight line. So you can see there was a break there, and I failed there. There was another break here, which is this level here. Notice the stock almost came back to that previous break point and failed. I'm just talking about what we learned at the beginning of this video. There was another break point there and a failure. So this, remember, the break point was here. It came back, tested that area, failed. Again, there was another break of that trend line. JCPenney has just a perfect chart for showing that, because when I saw this, I was like, I might have to show this. It broke down there. This is a break. Notice it never got there. It would have another trend line there. This break point, draw a straight line, it failed again there. And most recently, there was a break of this trend line here. Draw a line here, it failed again there. Okay, so JCPenney has been just doesn't look good. Multiple reasons to not like the stock. I want to take a look at this one from a monthly chart, because I believe it's going to give us our first perfect example of stocks that are in trouble. I'm going to go back a couple of years here for JCPenney. Let me go back about 7 years here, just so that we can get the I know what I'm telling you is dead on accurate. So I might have to go back even further just to get the example. Oops, bear with me here. All right, remember I talked about the 3 year monthly low. JCPenney, ever since it broke down, this is in the 75s in 2007. So it broke down here to 3-year highs. So that was the 3-year low here. 3-year monthly lows on the RSI was here, middle of 2007, and you can see that also corresponds with the accelerated move low. And then again, you can see recently there was a move to 3-year highs here, which corresponds to this move here and then lower. So 3-year lows, 09 here, 09, so 2012, break to 3-year lows on the RSI, break right there. And also notice it has been unable to capture that break point, so this break point here. So JCPenney has had two in the last, let's call it 10 years, a break to 3-year lows there on the RSI, never want to do that, okay? And then another break, remember I said 3-year lows on the RSI, so, and it's not been able to recapture that level. And that's why the stock has been in trouble. So now one thing I wanted to do when I was putting the examples that I'm going to share with you, I wanted to make sure that I capture some of the most important developments in the stock market over the last 20 years maybe. I just wanted to recapture so you can get a feel for the things that the webinar was about. I wanted the webinar to be so accurate, and there's so many examples. You can pick commodities, you can pick currencies, you can pick bonds, so many things to I don't know, I didn't know which way to go, but what I did is I have a group of examples, and I try to capture some of the best samples so we can know that for a fact, if we can understand these simple things that I'm talking about here, once we understand them, that they can help us in any market, any instrument, anywhere in the world. And that was my initial desire. So to go back to what I've been talking about here, just to rehash, a stock tries to break out here, the green arrow, this is a weekly closing high, tries to break out and fails. So that's your first red flag. Okay, now remember that the one thing I forgot to mention, and I think I should mention it, is because I think some of these things can be confusing. So you have your 10-week moving average, and then you get your 33-week moving average, and they cross over. This lowest close can be anywhere closed. It can be here, it can be here, it can be here. So it could be even slightly above the 10-week moving average. But what you're looking for is evidence that the market is going to push lower and continue pushing lower, and you're just looking for entry points. So this entry point where the stock closes lower, heads higher for a couple of weeks, and then breaks down could be just around the 10-week moving average, or slightly above it or slightly below it. Remember, I said it does take a little bit of just being intelligent in where you decide your entry points. Okay, there's no set rule. The market is volatile, so I can't just show you one method that works without some adjustments. You might have to adjust your game plan if you want to win. That's what I'm saying. Okay, so, and this is a perfect example. You can see that the 10-week moving average in my example is above, is there. The lowest close is above the 10-week moving average. The stock tries to move higher, comes back and fails. So this failure point is your get out of the stock, sell the stock or short the stock there. It settles down here, moves higher. So this becomes your latest entry point if broken to the downside. That's why I said you need patience. It comes back and breaks that level again. So that's your entry point again. So now you remember you're playing this bend, the bend of the 10-week moving average, which suggests that there will be a crossover between these two averages. So once it comes down, settles here, moves higher and breaks again, you have another entry point. So you might have one entry point, you might have several entry points. It just depends on the stock. But let me leave that chart there so you can look at it again. Remember, points A are all just where you want to go short or where you want to get out of the stock. All right, now previous points A I mentioned. The previous points in the slides, sell or short points, anticipate the bending of the 10-week moving average or the 13-week moving average and subsequent bearish crossover. All right, so you get that. So every time the stock settles down, moves higher, comes back, that's your sell point. Settles down around here, moves up, comes back, that's your sell point or short point. And then just around here again, makes a low, moves higher for at least 1 week or more, breaks down, that's your area where you want to go short. All right, so now let's go to the examples. We're going to begin here with the S&P 500. Now, as you can see, the S&P 500, this is 2008. So we know what happened in 2008. We know what happened in 2009. And this example is perfect. You see, we tried to break out here late 2007 and failed. So that was our first mistake. We came down here after this failed breakout. We would come here, make a low. Okay. While we are making a low here, the moving average is already starting to show signs that it is bending, and eventually it's going to cross over for a bearish crossover. So we set this as our short point. Okay, so notice what the market here, the market came back in 2007, and it's important we understand this because the market did try to rally here. It tries to jump here, fails, and guess where it fails? It fails precisely at the crossover point here. It comes down, so once it breaks below this, our lowest close, this was an area to go short. Now notice this break point here. The break point was tested again here in 2008 and it failed. So remember, a previous break point being tested and a failure is an ideal place to go short. Also notice that the S&P 500 would eventually make a low here, and this became an area to go short again because it was a little bit convoluted here because we came here, broke down, came here, played with this area, and finally could not hold and we moved lower. So what I'm saying is just keep these things in mind. Sometimes we have to adjust some things here and there for things to really make sense. Okay. Also, it's important to note that had we looked at this chart in 2007, 2008, 2009, we would have known that we were in a bear market just because we had the crossover between the 10-week moving average and the 33-week moving average on the S&P 500, and the market didn't have to be very confusing. Okay, lots of examples here. This is a Boeing BA in 2008. Same thing. It tried to break out here, failed. X. So that's a fast red flag. It would come down, settle here. So now you wait. You set that as your short point. Let's call it $93 here. So 93, and you wait. Just be patient. It moves higher for about 2-3 weeks and finally comes back. And once it breaks below 93 there, you want to get out or short the stock. You would come back, make a low, come here, try and retest this breakpoint and fail. Another sell point. At the same time, we had the crossover taking place there. So lots of things going on. It's very simple, but lots of things going on. Also, I show you where it broke down. So this was another entry point there, that low. So you short the stock when it breaks down there. Notice it tried to move above that breakpoint and failed. Same thing here. That low it broke down here, and this also became a resistance level. So maybe it's confusing, maybe it's not, but I hope it makes sense. This is just another stock I was looking at. BRLC 2008, same thing. It tried to break out here twice. It had 2 weeks of rest, broke out here, failed. Short it there or sell or get out. It came back, tried to break out above this weekly closing high there and failed. So that's another error. And then also notice the crossover was taking place somewhere here. So every time it comes down, settles down, tries to rally, and the next breakpoint like here, get out. It came back and formed a low right there, somewhere around here, moved higher. The next time it comes down, this is where you want the move to new lows here. This level here is when you want to go short. You want to go short at this break point here. You want to go short at this break point here. So lots of entry points, but I would rather, if you're going to do this perfectly, you want to do it here before this or around the crossover. This is where you get the maximum move. Okay, I would not like to do it here or here or here, even though you can, and you can see this as successful in going short. But if you really want to get the best move comes when you are crossing over here and when the stock is making a monthly 3-year low. All right, let's take a look at another idea here. And same thing. I mean, and I want to spend more time on the bigger picture example. So breakout attempt here. This was a weekly closing high. Came here, tried to break out, failed. So you can short the stock right there at the failure point. Okay. Now remember, you don't know. And like I said, we are always trading blind. So you don't know whether the stock is going to break out. But so at the time you're looking at the stock, you know the stock tried to break out. It's lower. It could eventually break out. And they do. But all you can do is once you see that the breakout has failed and you own the stock, you can choose to sell because this is not a good sign. Good stocks break out and they continue moving higher. Questionable stocks attempt to break out and fail. And once they fail, it tells you something's going on. So you can see before the crossover here that this was the lowest close. So you want to short the stock at the break point. There was another low here. Short the stock at the break point somewhere here. And this one took a couple of weeks before it finally would start moving lower. All right, I'm going to skip this one just because there's so many ahead of us. But again, you see a failed breakout. In this particular example was the best time to go short. Failed breakout. That's your first mistake. Failed breakout, you want to get out. Now, I want to take a look at the Brazilian chart that I showed you in the webinar. And the Brazilian chart, the Bovespa, I think it's a good example. You notice this market is down 41%, I believe, since this high here. So this is a major market that was making multi-year lows, all right? You notice there was a failed breakout here and a failed breakout attempt here. So that was your first red flag. There was another trend break there. Lots of things in this chart, and I don't want it to get too busy. All right, so we broke down here in this So this line here, this line, we broke down, and so you draw a line there. So there was a test of this level that failed. There was another test down the road of this break point here, this break point here. Draw a straight line. So we failed here and we failed here. So multiple areas to short stocks at the previous breakpoints. But for the purpose of this video, let's take a look at what we've learned. We had a crossover here. So the lowest close was here. So the stock moved higher for a couple of months, and on a weekly chart, once it broke down below that level here, that was the time to go short. And I can also see there were many other areas where it would have triggered short points. Every time it makes a fresh low like there, or even there, you want to short the stock. And lately, we see that there was another crossover, bearish crossover here. So we can see that as of 2013, this break here, this lowest close, that once it broke below that level there, it showed you that this market was going down. It came back and tested this level here and failed. Hope that makes sense. So what I'm just showing you is that there are multiple levels to short, and then there's another break here recently that the stock has never been able to move above that. So the Brazilian market is not down by surprise. If you look at the things that we are looking for in this educational part of how to short winning stocks, it makes a lot of sense. Now I want to go to the main examples. Now the previous examples were just examples I just came across while preparing for this. This is December of 1987. Why am I doing this? I want to take you back to an area of the market where we had this, and most of us were not trading. This crash of 1987, Black Friday. Was it Black Friday or Black Tuesday? At any rate, this crash here was very important, and it's just one of those things we always study whenever we are new into the market. What I want to point out here is, let's take a look at the things that we've learned today and to see whether they make sense. Okay, so this is the Dow in 1987. Notice what happens here. The Dow had broken out. That was the highest close. Draw a straight line. So the Dow broke out here in July or June of 1987 and moved higher. There was no other fresh buy point. Okay, so the Dow would come make a new high there. Now, so you draw a line. Now, there was an excuse me, there was an attempt here to come close to this level here, the breakout point, that failed. So we can say, just for the purpose of education, it never got as high, back as high as the breakout level of 2,700. So it fails to capture the new high and then comes down. So this monthly or this weekly closing low could have been your sign that something was different in the market. The market moves, tries to attack this 2,700 level and then breaks. Once it breaks here, something is not right, because this was the lowest weekly close. Here, the market went up for 2 weeks. Week 1 there, week 2, and then on the 4th week, it broke below that point. So this was an area to get out. Now, this is on hindsight, okay? But notice what happens is we started seeing the bend here taking place. After this week here, this week there was a bending of the 10-week moving average, which was bearish, and then the crossover was also another sign that something was not right. So this example does show us that the crossover and also the break of this level here and the bending of the 10-week moving average were warning signs that something was looming. Remember, I'm doing this on hindsight. It's easier for me to say that it looks obvious. Of course it wasn't, but at least the charts don't lie. Let's take a look at crude oil 1987. Now, I don't know what was happening to crude oil in the 80s. I don't know, but I can tell you what the charts look like. In late 85, you see here there was a failed breakout attempt. You had about 2 weeks of rest, and on the 4th week, crude oil tried to break out to new highs and failed. The following week, it failed. So that was a failed breakout, so your first red flag. And then it moved below the 10-week moving average. The 10-week moving average started bending to the downside. There was a crossover, so many things. And then after almost 1, 2, 3, 4 straight down weeks, we settled there. We had 1 week. Remember I said minimum 1 week. So here's your minimum 1 week, up and then down. At the point of breaking below that level, you want to short crude oil. Crude oil would move from about, after, remember the first failed breakout attempt was at about in the 30s. So your first red flag crossover was here in the 28 level, and then a break point here about 26. Eventually crude oil will go as low as $10. That's a major drop in any market. So the things we are learning here could have worked in the 80s. Now, isn't that nice to know? It is nice to know for me. All right, let's move on. Now we are going back to crude oil. Same instrument, but now we are going back. It's 20 years down the road. This is 2006. All right, so 2006, almost 20 years later, the same principles, could they really work? Let me show you. They do work. So crude oil settled here. This is a winning stock. This market moved from $50 and went as high as 147 here. Okay, so this is a winning stock. Remember, title of the webinar, how to short and sell winning stocks. Notice it made a high there. So, and was trying to break out, was breaking out after 2 weeks of rest, went higher for the next 1, 2, 3 weeks, and on the 4th week it failed. So that's your first indication to go short or to sell and get out of that instrument. It would move back below the 10-week moving average. The 10-week moving average has a sharp bend, which is bearish. You can see the blue line. It settled down for 1 week, went higher for 1 week, which is, I said, was the minimum, and then just like in 80, 86, 85, once it broke down there, that was where you wanted to go short. So we have everything we are looking for. Again, it came down for a couple of weeks, settled down, moved higher, and once it broke down below there, that was another point to go short. Again, another point to go short was after this up, settled down here, went up, broke down. So every break, this is perfect because this is exactly what this video is about. Failed breakout. You have a crossover between the 10-week moving average and the 33-week moving average. You have the break of this low, that low being broken, that low being broken, short it again, that low being broken, short it again, that low being broken, short the stock again or the instrument. So the principles we are learning here are legit. Let's take a look at NASDAQ. This is March of 2001, but the chart goes back a couple years. Notice one thing here. This is now a weekly chart for the NASDAQ. Okay, so the NASDAQ had a major run in the late 90s, going into March of 2000. So it broke out here, and for the next 5 weeks made continued all-time highs, and then it would come back and break. Now notice this break point here, or this former buy point, now becomes resistance down the road. It was resistance here, time to go short. Was resistance here, time to go short. All right, makes sense? So this line, this level here, which was the buy point, extend that line, and you can see down the road, markets have a memory. Sell. Once it broke down here, this break point becomes a sell down the road. Perfect. Sell again or short. Now, so the NASDAQ went down for heavy. It went down heavy for 3 straight weeks. Week 1, week 2, week 3, and then settled here. Okay. Came back and broke that level. So this was an area to go short. But notice one thing, and I really have to stress this. It did not work out. All right. This break here was a time to go short. But guess what the market did? After 1 week of down week, it recaptured that level. So what I'm saying is once, let me take that off. So it broke down here, time to go short. Best time to go short, okay? Because we have this crossover here. tells you you need to go short at the next break. This break failed. So once the market recaptures this level here, you want to get out, because this was the low, the market, so you went higher and you knew that any break of this level here was time to go short. But if the market comes back and recaptures the level, which is this level here, once it recaptures that level, you want to get out, because that shows you that this break was false. And this is perfect example, because the market recaptured this break point here, recaptured it here, and moved higher for a couple of months, if not, yeah, a couple of months. But notice what happens down the road. Down the road, couple of things. A, we already talked about these red flags here and here, stemming from this break point here. So that was very obvious, kind of obvious. But notice one thing. So we come back here, we close below here. So this weekly closing low was important. Why? Because you start seeing the Nasdaq bending. The Nasdaq starts bending here. You can see it's gonna cross underneath the 33-week moving average. So you know the next break, which was this point here, you wanna get short, and it worked perfectly. And then this low here, so this one failed, so that you lost money there if you didn't get out. So you have to get out of these things when they're not working. But down the road, once we broke below that, we never recaptured that level. After weeks of playing around here, once we broke below that decisively here, we never recaptured that level. So does this show us that the market does respond to the things we're talking about? I believe so. And I hope you can see what I'm talking about. Also notice, those of you who've studied my work and you know about what I call the uniformity, notice the RSI broke down here, which is this break point here. The RSI was also tested here, and each time it failed corresponds to that sell point and that sell point, which is here and here. So the RSI was also confirming sell points as far as the Nasdaq was concerned. Let's move on here. So now this is the Nasdaq, the same chart, but now the monthly chart. And you'll notice that the reason why I want to show you is that the accelerated move to the downside, bring that back. The accelerated move to the downside began here in October. This is when the break of that level here, which is this line, once the market broke down there, we had a very accelerated move to the downside. All right, remember this is 5,000 and this is 1,800, and we were talking big time losses. Amazing. Now I did trade this market and it was not fun at all. Okay, so remember what I'm talking, the big slide starts here in October. Why? Let me show you why. Because I told you the biggest moves in the market come when you break to 3-year lows on the RSI. So you have a RSI breaking to 3-year lows right there. Also moving below 50 right there corresponds to that October big move low, because we broke to 3-year lows on the RSI here. That low was broken right there. I want to take a look at what the MACDs were doing at the time, and you'll notice that at the time the MACDs were also moving to fresh lows. October period here, the MACDs were making 3-year lows, like I said, and a 3-year low on the MACD there. So 3-year lows on the RSI, 3-year lows on the MACD. Good. Now let's take a look at the Dow in early 2000s. Now the Dow, unlike the Nasdaq, when the Nasdaq was making major highs in early 2000, the Nasdaq was making major highs. The Dow was in this flattish area. The Dow didn't do much in 99 and early 2000. What I want to talk about is, if you take a look at the Dow, this was the highest monthly close there. From my vantage point, I circle it in green. And the market failed many times to hold above that level. It would try to break out, didn't close above it. Closed above it here, the next month closed below it. Tried to close above that level, failed. Closed above it 1 month and the next month below that line. Tried to break out, failed, failed. Finally, it went down. I mean, this is amazing, all right? Let me show you. Just failure. The only time it closed above this period here was this month and that month, and each subsequent month was down, back below the line. So this, you knew that Dow was in trouble. I'm not saying you would have known when to short it, but the best time to short it is when you see the crossover here on the monthly. All right, so you set that as your entry point. Once this was broken, you want to go short right there. You might say, Eric, but that was not successful. Yes, it was, because the Dow moved from about 9,800 all the way to just above 8,000. That's more than a 15-20% drop in one month. Remember, this was September here, September 2000. So this was successful. Are you gonna know that the market was gonna bounce? Maybe not, but that doesn't matter, because you at least, what we're talking about here worked for this month here, for 15% correction in 1 month. I would take that any day. Okay, and it's important to note that this level here was successful here, and again when the market came back and broke back below this level here, it was successful. Now I have to point out something here, because I really love this. When the market was at its worst in September of 2000, which is this level here, this area, when the market was at its worst, guess what it was doing? It was also moving to 3-year lows on the RSI. Remember, I talked about the 3-year lows on the RSI. Very important. 3-year lows on the RSI, on the monthly chart. Monthly chart. So once we broke below that, you know for sure that there's something not good taking place in the market. Now, let me change gears here for a minute, because I want to switch. I believe, since we live in a dualistic universe, duality is everywhere. In fact, duality is the makeup of this reality. The one thing I want to point out, if you have a principle in the stock market that is good when the market is going up, it should also be good when the market is going down. And I believe the principles I'm showing you here are good when the market is going down. But those of you who've stayed with me for a long time, you know that the principles also work on the way up. In fact, I've just flipped them around, right? I've just flipped the 3-year high and the 3-year low requirement. Why? Because I want to show you that the 3-year high also works on the way up. This is now 2001. The market, this green line, when the market made a 3-year high on the RSI, 3-year high is what I'm trying to write here. 3-year high, this was an area to go long the market, and it's somewhere around here. Notice the crossover between the 10-week moving average. And where is your entry point? Your entry point is this monthly closing high. Let me take that off. So I'm just showing you this principle also works on the way up. It's very powerful because it is legit. This monthly closing high, the market came back. Notice it tried to, this was a monthly closing low. The market tried to break down and failed. So we are using the reverse, also works. Once this breakdown failed and the market recaptured that, that's your first, do they have a green flag in the stock market? That's your first indication that something is different. So that's a tick. And then this monthly closing high was your entry point there. Why? Because you're anticipating the crossover between these moving averages here on the monthly chart. So you enter right there. Hope that makes sense. So I know that these principles work because I've used these principles whenever I'm playing the upside in the market. And now I'm telling you that these principles can also work when shorting losing stocks to the downside because I've just flipped around the principles. Hope that makes sense. All right, let's take a look at the Dow Jones in 2009. Why? Because I want to show you that, you see this red line, this red arrow connects to that monthly closing low, that monthly closing low, and that monthly closing low. I drew a straight line, and guess what? We broke down here in early 2008, came back here and could not move above the line and whoop, crashed. All right. So basically the arrow, this arrow here, shows you the back test failing. Where did it fail? It failed right there. So this print, I don't know why, but the market seems to have lots of symmetry, because this line here, this red line, once broken here, became resistance and then subsequently down. Notice another thing is there was a trend here. If you take the lows here and this lows here, draw a straight line. We broke down here, draw a straight line. We never recaptured that level. Also notice that we had the bearish crossover there between the monthly chart, the moving averages here. We have a crossover. Now on the monthly charts, I use 21-month moving average and the 10-month moving average, but then there's still crossover is a crossover, bearish crossover. All right, just like you had a bullish crossover in 2003, you had a bearish crossover in 2008. Now what I want to point out here is a 3-month low. Notice here we broke down to 3-year lows here on the RSI. That was a beginning of a major bear market there. You have to understand the importance of that. Okay, we came back and broke to 3-year lows again here. Continuation of that bear market. You have to be very careful. Now by the time we broke down here, which was a reason to go short, and this break to multi-year lows, I mean this lows on the RSI were going back 2003. When we broke down here is why, if you remember, and I'm sure most of you know, this is why I called for the market to crash, because I talked about this break point here on the RSI, because I knew something we would all remember was about to take place. So that crash was so easy to identify, and it wasn't easy, but it was easy for me to identify because I knew we were making new 3-year lows, and also we were breaking down there. So these principles do work. Now let's take a look at crude oil, and we're looking at crude oil. Why did I have this a second time? Maybe I shouldn't have. This is the monthly chart, I guess. It's a monthly chart. So the monthly chart shows actually a weekly chart, but I'm gonna still show it. Break there of that breakout failed, crossover, sell it here, and sell it there. And that's moving from 147 all the way back to about 35. Let me see if there's another example. So now let's take a look at Japan here. And this is the Japanese market in the late 80s and the beginning of the 1990s. Why do I show this chart? I just want this video to be worthy of you guys, all right? Notice one thing. This is all-time highs in Japanese market. So we had a weekly closing high there. Japanese market broke out, had almost identical to the Nasdaq. The Nasdaq had almost 6 weeks to all-time highs. It would come back and fail, just failed below this red line. And notice now you have the bend of the 10-week moving average. That's bearish. And then the crossover between the 10-week moving average and the 33-week moving average. So you had your first 2 reasons to sell. Failed breakout, get out. Crossover, get out. So the market came back here. So this low here becomes your point to watch. So you have to be patient. The market tries to rally. Don't be in a hurry. You've already seen the mistakes. Failed breakout, crossovers. Once the market, notice what happens. The market didn't even touch this level. It gapped down. So you want to sell at that point. So yes, the things we are learning here are legit, because even in the late 80s, in a market that we don't trade day to day, the same principles worked. So that break was here. All right, this was the low, the lowest close after this failed breakout. So that becomes your entry point to the downside. It tried to rally. Don't worry about that. Once it comes here, you want to short right there. Perfect example. Now, this is the Japanese market from 1988 to the current market. So this is long time. All right. What I want to show you here is this is 38,000. This is close to 7,000, 6,000. Absolute terrible multi-decade bear market. So now I want to just show you one thing. Remember JC Penney? Notice the Japanese market. It breaks a trend there, draw a straight line. Down the road, that was a sell point. It breaks this trend again. This point, draw a straight line. Down the road, it tried to break out above that level, failed, shorted. Break point there. Down the road, this level here, it failed here. After weeks of attempts here, it finally failed, and notice how it just collapsed. Again, there was another trend break of this low and this low. Draw a trend line. There was a break there. It failed once in 2008. Sell it right there, and you can see right now we've been unable to move above this point, which reminds me of something similar to here. So one wonders whether this Japanese market is also gonna fail. I don't know. We'll see. All right, everybody always wants to talk about this stock. This is Apple 2013. The high here. Apple, just like the Nasdaq and just like the Japanese market, notice it broke out here and almost had 1, 2, 3, 4, 5, 6 weeks to the upside. This is identical to the Nasdaq in 2000 March. Identical to the Japanese market here in late 1988, right? And we see the Apple stock doing the same thing, and also crude oil the same thing. So we had breakout here, goes up, and then collapses. That's your first indication that Apple is in trouble. Get out. And I was bearish here. You'll see my videos on YouTube. So we come down here, we stall, we stop there, and then we try to rally. We have the crossover already, which is where it stalls. Prices don't move above the crossover point for some reason. There, short the stock, and then you have, so this low here becomes an entry point, and you notice this, once it broke below that level there, it never recaptured it on a closing basis. It moved above it during the week, but on a weekly basis, it never moved up. It never closed above this line here. This line, it doesn't close above it. So that was a perfect time to short the stock on a weekly basis. And then there was another entry point there. Once the stock tried to rally here, failed, so that was another point to get short. Now I have to point out, and I hope it's obvious to you, that this is now being tested, this break point. At this current market, the Apple stock is testing this level here. If it can't hold, it's gonna go lower. On the other hand, remember we talked about this, if it breaks out successfully, if it breaks out here, that's an area to go long. So we'll see what happens. Also notice we have the crossover now between the 10-week moving average and the 33-week moving average. So what I'm saying is, if it breaks out above this level here of about, let's call it 515 maybe, this closing high, if it breaks out, and with this crossover, this thing could be moving higher. The only thing that makes me not very sure whether it's a good buy is because it's not making a three-year high on the RSI. There's no 3-year high on the RSI, so any move is gonna be not very strong. All right, I'm gonna end the video here by taking a look at the S&P 500 at the current time right now. S&P 500 right now, and you can see that we're already showing signs of signs of a failed breakout here. This was a breakout level. It broke out for a couple of weeks and then it's now below that. And also, let me show you the next chart. This is the current chart for the S&P 500. So it does have, this is Apple. Oops, sorry. And I promise the video is just about to conclude. All right, this is the current chart for the S&P 500. This was the entry point. We broke out here, very nice breakout. We came all the way and broke below that, and we settled down for 1 week. Here moved higher for 1 week, and then we broke down. So the entry point in the last couple of weeks was this break point. So we also, if you look at this, you start seeing signs that the 10-week moving average is starting to bend to the downside. So the fact that it's holding below that level makes me wonder whether the S&P 500 is also going to be under downside pressure in the coming weeks and months. Of course, if it breaks back above this level here, which is this closing low, then maybe the market is going to be back and might try to attack this 1700 level. Right now, with the way things look, I'm not sure. I think I'm leaning more bearish. Just given this chart alone, things could change. Wow, this video is 1 hour long. Anyway, I have to give you your money's worth. We've covered Japanese market, crude oil in the 80s, in the 90s. We've covered the 2000s. We've covered today. We've covered Apple. We've covered pretty much major markets. I could have covered gold. I could have covered the dollar, but it's all the same thing. So I hope the video was not too confusing. Now, remember, you could have had the package where I can coach you and we can go through this very slowly if you need to, because remember, the same principles work on the way up just as they do work on the way down. So this is concluding the second part of this webinar. There's going to be part 3. Part 3 is going to be my best short ideas now in this current market. Best ideas in the market to go short right now. Eric Mwatha with the Educational Trader. Love you guys for giving me your support. Peace and blessings. See you on part 3. I am out. Mwah.